Hey everybody, I'm Telis Demos.
And I'm Miriam Gottfried.
And this is WSJ's Take on the Week, the weekly show where we give you a leg up on the worlds of money and investing.
Telis, retirement accounts like 401ks have something like $12 trillion in assets in them. And that is a big pool of money that the private equity firms have their eyes on.
And it makes total sense, right? Right now, most people are invested in vanilla stuff, stocks and bonds, but there's a whole world out there of privately held companies, the debt issued by those private companies, real estate, infrastructure. These are the stuff that these alternative asset managers have, and they'd love to have $12 trillion more places to put it.
That's right. Right now, only institutional investors pretty much can invest in that stuff, with a few high net worth individuals also being able to participate. But this is something that is really big and could be coming to our retirement accounts soon.
Yeah, I'd say it's one of the biggest stories in investment and in kind of the business of Wall Street going right now. We write about it all the time in the Wall Street Journal. And that's why we made this week's episode a little bit different, because we wanted to have two conversations to really dive into this topic. And we're going to have one conversation with a retirement industry expert about the hows and whys of the companies who are doing this. And then we're going to talk to a retirement investment expert about whether or not this might make sense for your portfolio.
And first up, we have Holly Verdeyen. She is a partner and U.S. defined contribution leader at Mercer.
Holly, welcome to the show.
Thank you so much, Telis. It's a pleasure to be here.
So tell us a little bit about what you do and what Mercer's role is in the world of investment and retirement and, asset allocation and stuff like that.
Absolutely. So I lead Mercer's defined contribution practice in the United States. And when you hear defined contribution, just think about individual participant-directed account plans like 401ks. That's really what defined contribution means. So in my role, I meet and talk regularly with large plan sponsors who are selecting and monitoring the investments that go into their 401k plans from which individual investors like you and I can choose from.
And plan sponsors are like companies, right? Like big companies. Like the company you work for, they are the sponsor of your plan, right?
Yes, they're a sponsor of a plan. And generally they're companies. There could be other types of entities. But yes, when we say plan sponsor, think your company that you work for that is sponsoring the 401k retirement plan that you invest in.
And maybe they're matching your contributions as well.
They're generally matching your contributions, yes.
Well, and so what we're talking today is essentially new options that might come through those plan sponsors for all of us, right? Everybody who contributes into a 401k and uses those company options.
Yeah, I mean, we're used to having pretty much stocks and bonds, and now we might have some new options related to private markets. What is actually coming possibly to 401ks?
Okay. So yes, you may have some new options, or you may have a new asset allocation of an existing option that you have come to understand, like a target date fund or a balanced fund. Some of that public market exposure could go into private markets in the future.
So a target date fund, can you just explain? Probably most of us are in them, but we might not know what they're called. Can you explain what a target date fund is?
Yes. A target date fund is a multi-asset portfolio that people invest in. They select the fund that matches up closest to their individual retirement date. So, for example, if my retirement date is projected to be 2040, I would select the 2040 target date fund. And that target date fund is going to give me an age-appropriate asset allocation today. And that asset allocation is going to gradually de-risk and become more conservative over time as I approach that target date. So it's really a one-stop shop. It's where the majority of people's assets are actually going today in defined contribution plans, because it tends to be the option that people get put in if they don't affirmatively select a different option. And so target date funds are a really right place to consider private assets.
These private market assets could become part of our target date funds.
These private market assets could become part of our target date funds, substituting out either public equities or public fixed income or even public real assets. Target date funds are really an ideal place to consider private assets, because within a multi-asset portfolio, as a sleeve or a sliver, maybe we're talking between 10% and 20%, somewhere in there, of private asset exposure. The public market exposure, which is now we're talking, 90 to plus percent could be used to actually raise the liquidity needed for the private asset exposure. So private assets are kind of by their nature long-term investments that have a long investment time horizon. It's patient capital. People should not expect liquidity during that time. People should not expect to be able to trade that portfolio or receive, regular daily valuations. So you have to create liquidity around it to accommodate the defined contribution ecosystem. People have become accustomed to being able to trade, get in and out of their investments daily, to be able to sell, to be able to get liquidity out of their 401k plan and raise cash daily. And so by putting private assets in a target date fund, you can use the bulk of the assets that are publicly traded as the liquidity piece of that target date fund and be able to really harness the illiquidity premium of private assets to the greatest degree by, not being able to, getting compensated for the lockup on your money and not having to trade them to raise the liquidity needs of people going in and out of the 401k plan.
So you might still have the same allocation of equities and debt. It just might be a mix of public and private equities and public and private forms of debt.
Yeah, if you're just talking about the broad categories of equity and debt, that asset allocation may not change materially. But underneath that, the sources of the risk and return of the debt and the equity could change. What I would highlight there, though, is putting private assets into a target date fund. It really does change the risk and return characteristics of what we call that glide path, or how participants are automatically de-risked over time. And so you want to just make sure that you reevaluate a glide path, even if it's the same provider, even if it's the same overall mix of equity and bonds. You want to make sure that you reevaluate that if private equity or private assets do become a component of that, because it does really materially change the risk and return trade-off for people.
Because of the illiquidity of these assets?
Because of the drivers of risk and return are different. You're just investing in different types of exposures. So if you think about, public equity, for example, you certainly wouldn't expect that a portfolio manager of a fund that owns publicly traded stocks is really going to have that much day-to-day hands-on influence over how those companies are managed. In private equity, where these deals are sourced and owned, by a private equity company, that company is going to have a lot of hands-on influence about how that company is managed and how that company grows. And so the nature of the risks, the nature of the sources of return are just different. And it does have to do a bit with the illiquidity, right? People expect a premium for the increased risk of having their money locked up for an extended period of time. That's the illiquidity premium. There is a premium that comes from the illiquid nature of private equity and private debt, but there are also just different drivers of return that has to do with the underlying deals that are being sourced and invested in that are just away from the public markets. And there's a much more hands-on, active, transformational component element to those types of funds.
What might be an example of that?
Yeah, so in general, private equity transactions involve established companies with strong cash flows that are purchased by private equity firms who feel that they can employ their scale and their professionalism and their strategic insights to unlock greater operating efficiencies and higher future growth, and then exit those companies through an IPO or a sale. And so, of course, there's different types of strategies, but generally they're financed with debt, so they're leveraged. And I would say that they're generally, there's exceptions to this, but generally skewed to the larger end of the market, companies that could be professionalized, scaled, and sold at a premium. And by the very nature of private assets, they have a much longer investment commitment than funds that are comprised of publicly traded securities. And the returns on our invested capital are generally not realized right away. It takes about 10 years to fully realize the payoff for investors. And it's those folks, those general partners in the private equity funds that are really driving what companies you and I would have exposure to. And it would be my company's job or the plan sponsor to really evaluate when I'm selecting these funds to make available, does this firm have a proven track record of being able to find good investments that add value and generate returns over time? And then the tricky part is, Telis, that before we even know if the companies in this first private equity fund are going to pay off, we have to decide if we want to invest in the second private equity fund, Fund 2. So it just takes a lot longer to realize the returns and to know if this transformative active management strategy is paying off. And in the meantime, the fiduciaries for the 401k plan need to decide, shall I invest in this next vintage? Now, I will say this. This can be delegated to the target date fund managers or the multi-asset fund managers. The company, the plan sponsor of the retirement plan, remains responsible for overseeing that and being comfortable that who's ever making those decisions has a prudent process and can demonstrate skill in doing that.
It sounds like a lot is riding on our employers to make the right call here. Is that why these plans haven't been adopted more widely? Because I know that there are some target date funds out there already that have private markets as a component of them, but they haven't necessarily taken off yet. What is stopping people from adopting this more widely?
So yeah, we can't invest in things that aren't made available to us. You know, the employer is really important in this private asset construct for a couple of reasons. One, private assets are not generally available to the average individual investor. Number one, they have really high asset minimums, really high thresholds to get in. So you need to have a lot of money to even be an eligible investor. They're limited to accredited investors today in the US. You have to prove that you can meet some standards to be able to invest in them. So the average people walking around on the street today are not going to have access to private assets. But through their employer, who is considered an institutional investor because they're controlling a big retirement pool of assets, they could choose to make those private assets available. So that is one of the benefits of private assets in 401k plans, is that it makes them available to people who would not ordinarily have access. So there was a time when companies could not even have product available to them to consider. But things are changing with this administration. This administration is known to be more pro-business, in favor of less regulatory oversight, in favor of lower interest rates. All those things are a tailwind for private equity. So the private equity companies have really leaned into this administration to unlock new and very sizable sources of capital with 401k retirement plans. Because of this, there's a lot more product development for the defined contribution marketplace specifically. So now 401k plan fiduciaries have new product that they can actually consider that could meet with the requirements of a defined contribution or a 401k plan.
And it seems like another big component that has tripped up plan sponsors in the past is the fees. These products tend to come with higher fees than a pure mix of publicly traded stocks and bonds.
Yeah, I mean, it's pretty much active management on steroids. It is a much more hands-on, specialized investment strategy that you have to pay more for. So yes, the fees of private assets are going to be materially higher than their publicly traded counterparts. And participants have to be willing to pay for that. Now, getting liquidity into a 401k plan comes with a cost. You're paying for the illiquidity premium. You're paying for the expectation that after having your money locked up for that long, you're going to come out with a superior return. And you're also paying for exposures that are differentiated to what you could get in the public markets. So those are all the things that you're paying for. You're paying for a transformative hands-on investment strategy. You're paying for risk and return drivers that are different than what you could go out there and buy there out in the market today, either through a passive strategy or even through an actively managed strategy. So once you add these liquidity buffers and these other types of accommodations for the 401k marketplace, are the returns that you're left with after fees that much more superior to what you could get in the public markets that it's really worth the accommodations to put them in. Now, the last thing I'll say about that is more and more companies in this country are privately owned, and more investment opportunities are only available to private market investors. So the actively managed investment opportunity for 401k participants has been shrinking over time. And one could say that, their fishing pond is slowly drying up. And if we don't give them access to the private markets, their opportunity set and ability to diversify is just going to continue to shrink.
Holly, we've got one more question before we let you go. In 30 seconds or less, do you think that most workers will have a private investment option in their 401k within the next 5 years?
I was hoping you'd say 5 years. Yes, I do. I do think that some private asset exposure is going to make its way into multi-asset portfolios and defined contribution plans in the next 5 years. Tell us, it may not be private equity. Everybody wants to talk about private equity. We have to remember that there's core private real estate, there's private infrastructure, there's private credit. Those things are as well or better suited for the 401k ecosystem as private equity. So I think there will be some private asset exposure. It may not be private equity.
All right, so private something probably coming to your 401k within the next 5 years.
Yes.
Holly, thank you so much for this conversation. It's been super interesting.
Thank you so much. It's been a pleasure.
And now we're here with our retirement investing expert, our illustrious colleague, Anne Tergesen, who covers personal finance and retirement for the Wall Street Journal. Thanks for coming, Anne.
Oh, well, thanks for having me.
And a lot of this conversation about private investments in 401ks has been not just, should you or I go and seek out this sort of thing, but whether or not it's going to come to us in the form of target date funds. So I just wanted to talk for a second about the role that those play. Is that how most people invest their 401ks these days? I mean, it seems like, I know it's been all the jobs I've ever had, they've had that option. Is that really the kind of the workhorse of 401k investing for people?
Yeah, that's a good word for it. It is. And 60 cents of every dollar that goes into 401ks these days goes into target date funds.
Okay, wow.
And the reason why they're so dominant is because in plans that automatically enroll workers, and more 401k plans do automatically enroll people when they start a new job, they'll automatically enroll you. And the dollars that are automatically enrolled go into a target date fund unless the participant decides they don't want that. You can always opt out. But if you don't opt out, a lot of people don't, the money will just go into the target date fund.
So you would have to log in and manually select your investments in order to opt out.
Yeah, or call or the 800 number of the record keeper. Whatever the mechanism is, you can absolutely opt out.
And who are the big names in target date funds? Like who are some of the major providers?
So by far the major one is Vanguard.
Okay.
Yeah, and then Fidelity's number 2, T. Rowe Price is number 3. BlackRock, State Street, those are big ones too.
So who's the real gatekeeper of who will really green light this thing?
First of all, you've got the target date fund providers, right? So here in this case, we had State Street partnering up with Apollo to offer a target date fund with private investments in it. And now State Street also offers target date funds without private investments, right? So it's just basically expanding its product line to say to plan sponsors, to the employers, if you want private investments, here, you can choose, our new target date fund that includes them. So the State Streets, the Vanguards, the target date fund providers of the world have to make the decision to add it to their target date funds. And then on, the second level is that plan sponsors, the employers with 401k plans, have to make the decision that they want to include that in their 401k plans. They want to choose the target date fund with the private assets in them.
Within the equities, within the bonds, that stuff is pretty passive, right? Like the equities might be the S&P 500. It's not, or are there a lot of target date funds where there's a manager actively picking, this stock, that stock?
Right. So interestingly, you have seen more and more target date money is in the passive side of it. And Vanguard being so big in this market just tells you that right there, that Vanguard's...
Because they're famous for their passive investment strategies.
Exactly.
Right?
So most of the money that they manage in target date is passively invested in these index funds, very low cost. And that's also been very beneficial for investors. But there are certain target date funds. I think Fidelity has some, T. Rowe Price has some, and, American funds, and for example, that are at least partially actively managed. So it really just depends. And that's another decision for the plan sponsor, for the employer to make, is do they want to have a mostly passively managed target date fund? Do they want, partial, a hybrid, some active, some passive? Do they want most of it active? And so you can kind of get whichever variety you want.
And that can affect the fees too, right? The more active management you have within the target date fund, the higher the fees.
Absolutely.
What are the major hurdles that are standing in plan sponsors' way when it comes to adopting this stuff?
Yeah. So, as you pointed out, fees, right? So if you are going to add even a small amount, small allocation to private equity, private credit in your 401k, that's going to drive up the fees, right? Participants who are aware and engaged generally they're very cognizant of the fees. They don't want them going up. Secondly, the second thing that's been a real problem for larger companies is 401k litigation. And so a lot of that litigation is driven by fees. So when you raise the fees, you become sort of a more enticing target for plaintiffs' lawsuits. And those can be very expensive, even if
basically
you settle.
Just trying to argue that these fees don't justify the returns.
Yeah, exactly.
It's been one way for the private investments for institutional investors.
Right.
But there's no telling whether those same returns will be applicable to the individual investor market because, as we've heard, individual investors have a greater need for liquidity than institutional investors. And that's actually one thing I wanted to ask you about, Anne.
Yeah.
Liquidity. How much do people actually take money out of their 401ks? How important is liquidity really when it comes to a 401k?
Well, so I guess the theory as to why they would just put a small piece of it into private investments, maybe 10% or so, is that most people, if they're going to take a 401k loan, there's sort of restrictions imposed on the amounts you can take out. So you're not going to be able to take out 100% for a 401k loan. So the thinking is, well, people are going to be able to take some liquidity from the publicly traded portion of their portfolios without touching that private portion. In fact, where you really see a lot of people breaking into their 401ks is when they leave companies, something like 30 or 40% cash out. They sell everything and they take the money. And so I guess at that point, though, the plan's going to have to figure out a way to provide liquidity.
The big thing that I hear from the asset managers that are trying to get into this, trying to bring private markets to 401ks, is access. This is their big thing. They say, there are so many private companies that individual investors do not have access to right now, and we are democratizing alternatives by allowing them to have access. According to Apollo, 87% of companies with $100 million or more in revenue are private. So that's actually kind of a surprisingly large number. Is there a concern in the 401k world about individuals not having enough access to the vast, economy that exists?
Yeah, given how narrowly the S&P 500 the S&P 500 is an index of a handful of technology companies in a lot of ways.
Yeah.
Often.
Yeah, no, that's absolutely, I think, something that does resonate with plan sponsors and even those who are afraid of lawsuits. They understand that. They understand those numbers. And, it was easier to ignore this when it was a smaller percentage of the market cap. But now, I've heard from another large company that private companies comprise about 10% of the global market cap. So that becomes something that's harder to ignore. And so I think there is a lot of awareness that, that individual investors do deserve a kind of need to have some access to that for diversification purposes and, for opportunity purposes and investing in, important companies.
Yeah.
Are these kind of private investments a good fit for people who are not, 20 or 30 or 40 and thinking about, 20 years from now, but people who are, close to or now in their retirements are thinking about like their income for this year versus growing that money over time. Does that make a difference?
Yeah, so that's where when I've spoken to target date fund providers, they talk about how private equity is a lot more appropriate for younger investors who can afford these longer lockups. For older investors, as they get near to needing that liquidity, needing to draw down their assets, they're saying in that case it's more private real estate and private credit that provide, some level of cash flows. Ideally, everybody should be looking for, the lowest fee options available, and there's an awful lot of, index funds out there. So if you're an investor who's engaged and you understand how to construct a diversified portfolio that makes sense for somebody your age, with your risk profile, et cetera, if you have the time and interest to go out there and research your options and curate a portfolio that's going to work for you, and you want to take on that risk level and that level of potential regret if things don't go well, then, go for it. And if it's a high fee one, then you need to be aware of that, and you need to think about how you might be able to work around that if possible. It's much better to do the target date fund when it's a higher fee option if your alternative is to end up sitting in cash for 30 years.
So, Anne, we wanted to ask you one more question before you go. And it was the same question that we put to Holly Verdeyen of Mercer as well. So I'm interested in your take as well. In 30 seconds or less, do you think that most people will have a private investment option in their 401k over the next 5 years?
As for the timetable, I just think that the lawsuits are a big impediment towards 401k sponsors jumping on this quickly. I think adoption's going to be kind of slow, so I'm not convinced it's going to happen in the next 5 years.
Anne, this has been fascinating. Thanks so much for joining us.
Oh, you're welcome. Thanks for having me.